If you look carefully at economic history, one fact becomes impossible to ignore. The greatest financial damage is rarely caused by sudden catastrophe. It is caused by slow, systematic erosion that occurs while people believe they are safe. Empires do not usually fall overnight. Currencies do not typically collapse in a single moment. Instead, they weaken quietly, gradually, almost politely, until one day people realize that the assumptions they relied on no longer hold. This pattern has repeated across centuries, cultures, and monetary systems. The language changes, the institutions change, the technology changes, but the underlying mechanics remain remarkably consistent. Long periods of confidence are followed by periods of adjustment, and during those adjustments, the people who suffer most are not the reckless or the uninformed. They are the disciplined savers who believe that stillness meant security. You need to understand the cycle of monetary debasement. Every time governments face crisis, wars, pandemics, deep recessions, they do the same thing. They print more money. It happened during the Great Depression. It happened during World War II. It happened in 2008, and it happened massively during the 2020 pandemic. And between 2020 and 2022, the United States printed more money than in its entire previous history combined. Think about that for a moment. More than 240 years of American monetary history were surpassed in just 2 years. The consequences of this action are still unfolding, and 2026 will be the moment when they become impossible to ignore. We are approaching one of those moments now, and the window that matters is not some abstract future. It is the period leading into 2026, even with official inflation around 3 to 4%. Real inflation, the one you feel at the grocery station, and rent is substantially higher. Housing has risen 25% in the last 3 years. Food has risen 20%. Energy has risen 30%. If you kept a 100,000 idle during this period, you effectively to 20,000 to 25,000 in purchasing power. And the worst is yet to come. If you understand incentives, you understand behavior. The incentives for 2026 are creating a perfect storm that will make it extremely expensive to keep money idle. First incentive, American national debt has surpassed $33 trillion and is growing exponentially. The service on this debt, just the interest already, consumes more than $1 trillion per year of the federal budget. This means that even without creating new programs, the government needs more and more money just to pay interest on what it already owes. How does the government get this money? By printing more dollars. Second incentive, the aging of the American population is creating unprecedented fiscal pressures. Every day, more than 10,000 Americans turn 65 and become eligible for Medicare and Social Security. This phenomenon will continue for the next 15 years. The most dangerous idea during times like this is the belief that doing nothing is a neutral choice. History shows the opposite. In certain economic environments, inaction is not passive. It is a decision to accept the default outcome imposed by the system. And the system, when under strain, resolves that strain by transferring value away from idle money. For decades, people have been taught that risk lies primarily in markets. Stocks fluctuate, assets rise and fall, prices move unpredictably. Cash, by contrast, feels stable. It does not fluctuate. It does not produce headlines. It does not demand attention. On a statement, $1 always appears as $1, but stability in appearance is not the same as stability in reality. The years leading into 2026 are defined by exactly this kind of choice. Governments across the developed world are carrying levels of debt that would have been considered unthinkable a generation ago. Servicing that debt requires continuous access to cheap money. Demographic pressures are increasing mandatory spending regardless of political preference. Geopolitical competition is raising baseline expenditures that cannot easily be reduced. These are not temporary conditions. They are structural realities, and structural realities shape incentives. Over time, those distortions accumulate. They do not disappear. They wait. What makes this period particularly dangerous for idle money is not a single decision, but the accumulation of many decisions over many years. Each one made sense in isolation. Together, they have altered the environment in which money exists. Implement your changes gradually over 6 to 12 months, not all at once. If you need the money in the next 2 to 3 years, maintain a conservative reserve even if it loses to inflation. Short-term volatility can be worse than inflation. This is how wealth is transferred quietly, not through confiscation, but through normalization. When money is held idle during such periods, it absorbs the cost of adjustment. It becomes the shock absorber for the system. Its purchasing power declines so that other imbalances can be sustained longer. This is why 2026 matters. It represents the point at which cumulative pressures intersect with time. The decisions that were made to stabilize the system after previous crises do not unwind instantly. They express themselves gradually, then all at once. By the middle of this decade, many of those expressions become unavoidable. The real warning sign is structural alignment. When debt, demographics, policy incentives, and monetary tools all point in the same direction, outcomes narrow. The range of plausible futures shrinks. The system loses flexibility. In those moments, the question is not whether change will occur, but who will bear the cost of that change? Idle money has always been one of the primary bearers. The Weimar Republic in Germany faced exactly this situation. The government printed money to pay war, reparations, and finance internal spending. Initially, people who kept German marks in bank accounts thought they were being prudent, but as money printing accelerated, the mark lost value so rapidly that people needed wheelbarrows full of money to buy bread. Who was protected? Those who bought real assets, stocks, real estate, gold, even basic products like food and fuel. Who was destroyed? Those who maintained savings and marks. Not saying the United States will face hyperinflation like Germany, but I'm saying the principles are the same. When there's excess monetary creation, real assets preserve value and paper money loses value. Now, let's make this specific and practical for your situation. If you have 100,000 sitting in checking or savings accounts, you're effectively losing 3,000 to 4,000 per year in purchasing power, assuming the Fordham cent fest. But if inflation accelerates to 6 to 8%, something totally possible given the fundamentals we've discussed, you'll be losing 6,000 to 8,000 per year over 5 years. This represents 30 to 40,000 in lost purchasing power. Now multiply this by your specific situation. If you have $200 and double these numbers. If you have $500 and multiply by 5 for someone close to retirement. This is devastating. Imagine you plan to retire with $1 million in 2030. If you keep this money idle and average inflation is 6% per year, your million will have the purchasing power of approximately $750 and in today's dollars. As we move deeper into this decade, the cost of misunderstanding that difference increases. The window for gradual adjustment narrows. Decisions that could have been made calmly over years begin to feel compressed into shorter time frames. This is why inflation has been called the most subtle and effective mechanism of wealth redistribution ever created. It does not require force. It does not require deception. It simply relies on time and complacency. Those who understand how it works position themselves accordingly. Those who do not absorb the cost without protest. The Weimar Republic in Germany faced exactly this situation. The government printed money to pay war, reparations, and finance internal spending. Initially, people who kept German marks in bank accounts thought they were being prudent. But as money printing accelerated, the mark lost value so rapidly that people needed wheelbarrows full of money to buy bread. Who was protected? Those who bought real assets, stocks, real estate, gold, even basic products like food and fuel. Who was destroyed? Those who maintained savings and marks. Not saying the United States will face hyperinflation like Germany, but I'm saying the principles are the same. When there's excess monetary creation, real assets preserve value and paper money loses value. Now, let's make this specific and practical for your situation. If you have 100,000 sitting in checking or savings accounts, you're effectively losing 3,000 to 4,000 per year in purchasing power, assuming 3 to 4% inflation. But if inflation accelerates to 6 to 8%, something totally possible given the fundamentals we've discussed, you'd be losing 6,000 to 8,000 per year over 5 years. This represents 30,000 to 40,000 in lost purchasing power. Now, multiply this by your specific situation. If you have 200, double these numbers. If you have $500 and multiply by 5 for someone close to retirement. This is devastating. Imagine you plan to retire with $100 and $1 million in 2030. If you keep this money idle and average inflation is 6% per year, your million will have the purchasing power of approximately $750. In today's dollars, by then options are fewer, adjustments must be larger and more disruptive. What could have been done incrementally must be done under pressure. This is the trap that periods like the one leading into 2026 set so effectively. They lull people into a false sense of continuity. The world looks familiar. Institutions still function. Money still works. There is no obvious crisis demanding immediate change. And because there is no obvious crisis, people assume there is no urgency. Consider how often major adjustments are recognized only in hindsight. The end of the gold standard did not feel catastrophic in the moment. The inflation of the 1970s did not arrive all at once. The build-up to the global financial crisis was characterized by confidence, not fear. In each case, the conditions that made the outcome inevitable were present long before the outcome itself. What changed was not the facts, but perception, and perception always lags reality. Implement your changes gradually over 6 to 12 months, not all at once. If you need the money in the next 2 to 3 years, maintain a conservative reserve even if it loses to inflation. Short-term volatility can be worse than inflation. No one sends a bill for inflation. It is paid automatically through diminished purchasing power. As 2026 approaches, this automatic payment grows larger, not necessarily because inflation explodes, but because it persists. Persistence is what does the damage. A single year of elevated inflation is disruptive. A decade of moderate inflation is transformative. That accommodation has consequences. It changes the real value of money over time, and it does so regardless of individual intent. Inflation does not send invitations. It does not wait for consensus. It simply compounds. The mistake is treating it as static. This is why understanding the structure matters more than reacting to events. Events are symptoms. Structure is cause. In a stable system, this is not a problem. In a dynamic system undergoing structural adjustment, it is. This means that money creation is closely tied to debt creation. As long as credit expands, the money supply expands. Central banks influence this process by setting the conditions under which lending occurs. Governments influence it by running deficits that must be financed. When growth is strong and productivity is rising, this expansion can be absorbed. When growth slows or productivity gains are uneven, the expansion becomes inflationary. The claims keep growing. The output does not keep pace. In recent decades, this imbalance has been managed through globalization and technological efficiency. Cheaper labor, global supply chains, and rapid innovation allowed output to grow without corresponding wage pressures. This kept inflation subdued even as debt levels rose. Those forces are now changing. Supply chains are being restructured for resilience rather than efficiency. Labor markets are tightening due to demographic shifts. Energy transitions are capital intensive. These changes do not stop growth, but they alter its cost structure. At the same time, debt levels are higher than at most points in modern history. Servicing that debt at higher interest rates becomes increasingly difficult. This creates pressure to keep financial conditions accommodative. The machine is constrained by its own past actions. This is not speculation. It is arithmetic. This push and pull defines the modern economic environment. It does not resolve cleanly. It oscillates. Over time, the bias is toward accommodation rather than restraint. The result is a gradual erosion of the purchasing power of money, not in a straight line, not every year, but persistently enough that over a decade, the effect is substantial. This is why money must be understood as a moving part of the machine, not a neutral observer. Holding money is not opting out of the system. It is choosing a specific exposure within it. That exposure is to the unit of account itself. When the unit changes, the holder bears the consequence. This is not because assets are inherently superior. It is because they are connected to the output side of the machine rather than the claims side alone. As we approach the middle of this decade, the structure increasingly favors adjustment. The economic machine does not correct this mismatch for you. It enforces it. One of the clearest parallels to the current environment can be found in the inflationary period of the 1970s. At the time, the prevailing mood among cash savers was not fear, but confidence. Money in the bank felt safe. It earned interest. It did not fluctuate in value from day to day. For many households, especially those who had lived through the instability of earlier decades, holding cash felt like prudence. Meanwhile, those who owned assets experienced a different outcome. Property owners saw home values rise alongside inflation. Businesses with pricing power adjusted revenues upward. Equity holders, despite volatility, ultimately benefited from nominal growth embedded in the system. They did not avoid discomfort. Markets fluctuated, recessions occurred, but over time, their claims adjusted to the changing unit of account. The key distinction was not intelligence or foresight. It was exposure. Cash savers were exposed entirely to the currency. Asset holders were exposed to the real economy. This pattern was not unique to the 1970s. It appeared in various forms across the 20th century. After major wars, governments carried heavy debt burdens. To manage those burdens, financial repression and currency debasement became common tools. Interest rates were held below inflation. Savers were effectively taxed through negative real returns. Again, this was not framed as confiscation. It was framed as stability. In post-war Europe, families who held cash or government bonds believed they were preserving wealth. In reality, their purchasing power declined as currencies were adjusted to reflect new economic realities. Those who owned land, businesses, or productive capital fared better, not because they avoided risk, but because their assets were linked to reconstruction and growth. The same dynamic played out in emerging markets during periods of modernization. As economies expanded and financial systems developed, money supplies grew. Inflation followed. Savers who remained entirely in cash struggled to keep up. Those who participated in the growth of the economy through ownership saw different outcomes. This adjustment does not require crisis. It does not require collapse. It can occur gradually through sustained inflation that outpaces returns on safe nominal assets. Over time, the effect is the same. The real value of idle money declines. Retirement plans had to be revised. Housing aspirations were delayed. The cost of education rose faster than savings. These outcomes were not attributed to inflation directly. They were attributed to bad luck, changing times, or personal circumstances. The structural cause remained abstract. This is why historical comparisons are often misunderstood. People focus on dramatic episodes such as hyperinflation or market crashes and conclude that current conditions are different because they lack visible extremes. But the most consequential periods of wealth transfer are rarely dramatic. They're incremental. Inflation at 3 to 5% does not feel catastrophic. Over 1 year, it is manageable. Over 10 years, it is transformative. The math does not change based on perception. Another instructive example comes from the late 20th century transition away from gold-backed currencies. When monetary systems became fully fiat, the constraint on money creation shifted from physical scarcity to policy discipline. This allowed greater flexibility, but it also removed an automatic stabilizer. In the decades that followed, cycles of credit expansion and contraction became more pronounced. Each downturn was met with intervention. Each intervention increased the long-term supply of money relative to goods. Again, the intent was stabilization. The consequence was gradual debasement. Those who understood this early adjusted their behavior. They did not abandon money entirely. They treated it as a tool rather than a store of value. They allocated savings toward assets that could absorb inflation over time. Those who did not experience a quiet decline in relative purchasing power. Importantly, none of this required sophisticated financial knowledge. It required alignment with the structure of the system. Ownership of productive capacity in whatever form was accessible proved resilient. Passive reliance on currency did not. But inflation does not operate on a single-year basis. It compounds. After 5 years at 4%, the purchasing power of that 100,000 has declined by nearly 20%. After 10 years, it has declined by roughly 1/3. The nominal balance remains unchanged. The real capacity of that money has been quietly transferred elsewhere. This is not an estimate or a projection. It is a mathematical certainty. The only variable is the rate at which it occurs. When inflation persists, the cost of healthcare, housing, and daily necessities rises faster than nominal income. Each year, the same savings buy less security. Longevity risk compounds the problem. What feels conservative in the short term becomes dangerous over time. Then there are younger families. For them, inflation expresses itself through affordability. Housing prices rise faster than wages. Education costs escalate. Childcare becomes more expensive. Saving feels increasingly difficult, not because of poor discipline, but because the unit of account itself is losing ground. In this environment, holding idle money feels like falling behind while standing still. The goalposts move. The distance increases. Effort alone does not close the gap. Across all these groups, the common thread is that inflation operates invisibly. There is no bill sent to households. No line item labeled inflation tax, but the transfer occurs through relative prices. It is subtle, persistent, and mathematically relentless. This is why inflation is often misunderstood. People debate whether it is high or low, transitory or permanent. These debates miss the more important point. Even modest inflation Sustained over time materially alters economic outcomes. It favors activity over inactivity, ownership over holding, participation over passivity. The danger is not dramatic loss, it is gradual erosion. Gradual erosion is easy to tolerate and difficult to reverse. From a mathematical perspective, the risk of idle money is asymmetrical. The upside is limited. Cash does not compound meaningfully above inflation over long periods. The downside is persistent. Purchasing power declines with near certainty when structural conditions favor currency adjustment. This asymmetry is often obscured by short-term fluctuations. In some years, holding cash feels wise. Markets decline. Volatility rises. Cash appears stable. But stability is not the same as safety. Safety must be evaluated over the time frame that matters. The first principle is that wealth must be positioned within the economy, not outside of it. Money that remains idle exists only as a claim on future goods and services. Assets, by contrast, represent participation in the production, ownership, or scarcity of those goods and services. Over long periods marked by monetary expansion, participation consistently outperforms detachment. This does not mean abandoning caution. It means redefining it. True caution is not the avoidance of volatility. It is the avoidance of structural loss. The distinction is not semantic. A small, deliberate cash allocation increases flexibility. A large passive cash allocation increases exposure to inflationary erosion. The difference lies not in the instrument, but in the intent. This discipline is especially important during inflationary and transitional periods when relative prices shift unevenly. Some assets adjust quickly, others lag. Rebalancing captures these differences without requiring precise timing. A well-constructed framework accepts volatility as the cost of participation. It seeks to manage that cost, not eliminate it. The attempt to eliminate all volatility often leads to greater exposure to inflation and policy risk. The final principle is ongoing awareness. Economic systems evolve, policies shift, personal circumstances change. A strategy that made sense 5 years ago may no longer be appropriate. Regular review is not an admission of error, it is an acknowledgement of reality. This brings us back to the central idea. Doing nothing is not a neutral position in an environment shaped by high debt, ongoing monetary accommodation, and structural adjustment. Passivity carries a cost. That cost compounds quietly year after year. History does not punish uncertainty. It punishes inertia. The individuals and institutions that endure are not those who predict the future most accurately, but those who prepare for it most thoughtfully. The coming years will not be defined by a single event or decision. They will be defined by cumulative choices made under conditions of uncertainty. Whether idle money becomes a silent liability or a deliberate tool depends on those choices. Comfort has always been expensive in periods of change. Preparation, though less immediately satisfying, has consistently proven more affordable. The decision is not whether risk exists, it always does. The decision is which risk to bear consciously and which to absorb unconsciously.